Hi, everyone, and welcome to our November election edition of our Markets in 2 Minutes series. This is Darrell from the WealthSpire investment team. And of course, given the fact that the 2024 election is now behind us and we have some clarity on what the policy environment may be going forward, we wanted to touch on our interpretation of what type of impact the Trump policy agenda, or at least what we know of it thus far, might have on the markets and the economy at large. And this will be a slightly extended version of the series, just given that there's a lot to cover. But first, I want to preface this by saying that our view on public policy as it relates to the economy is that the markets in the economy are so complex and contain so many unique and distinct influences that they are not materially influenced by the goings-on in Washington, especially when you look out over an extended time horizon. With that being said, it's still very helpful to understand the net impacts of new policy initiatives on the economy because it does influence things on the margins and it does impact consumer and corporate behavior. And so that's what I'm going to attempt to parse through here today. This slide contains a quick summary of some of the key economic policy initiatives that Donald Trump shared during the campaign. First off, the Trump administration is likely to push for tax cuts on both individuals and corporations. He talked about cutting the corporate tax rate from 21% to 15%, and he's also discussed eliminating taxes on tips and overtime. Then, when it comes to trade, the big policy initiative that everyone has likely seen is the plan to implement tariffs on Chinese goods and reshore supply chains to the extent possible. Economists are really not in universal agreement with respect to the ultimate collective economic impacts of these policies, but it is clear that the market is anticipating that the Trump agenda is likely to lead to a moderate resurgence of inflation. The chart on this slide shows the break-even inflation rate that is priced into the market for Treasury inflation protected securities, or TIPS. And you can see that this has been steadily increasing, especially as the perceived probability of a Trump victory was rising. It remains to be seen which policies the administration ultimately chooses to prioritize first, but based on market pricing, it does appear that markets are broadly anticipating a bump in inflation. So the natural question then becomes, what might I do with my portfolio to account for this changing dynamic of structurally higher inflation going forward? And the answer is actually pretty simple, because the best places to turn are investments that you likely already own. From a portfolio perspective, equities tend to offer the best long-term inflation protection, but investors can also look to TIPS markets for some near-term structural protection. But this is not a development that we feel warrants a material adjustment to portfolio positioning. And on top of that, we would say it's important to approach this with some skepticism because it is really quite difficult to draw definitive linear conclusions when it comes to policy. And here's one historical example of what I mean by this. What we're showing here is Chinese exports to the US and Mexico over time. And you can see that beginning about 5 years ago, Chinese exports to the US began to plateau a bit, while exports to Mexico saw a pretty sizable and structural increase. And essentially what's going on is that companies began to circumvent the previous round of tariffs that the Trump administration implemented by exporting to Mexico first and then routing the goods into the US via the back door. So, to the extent that companies can continue doing something like this, or even accelerate some of this activity, it negates some of the potential inflationary impacts of tariffs on the broader economy. So the message I think is important to take away here is that perhaps we do see some resurgence of inflationary pressure if all of these policies are in fact enacted, but the long-term impact on the economy and markets is likely to happen on the margins rather than in one fell swoop, because a lot of these impacts get watered down by changing behaviors in a dynamic and complex economy, and so balance remains really important. Nevertheless, we'll be tracking all of this data very closely and we'll be sure to provide additional updates as actual tangible legislation gets put in place next year. But until then, we hope you all have a wonderful Thanksgiving and we'll return in December for another update. Thanks for listening.